For years, the Kremlin's core economic defense was simple: a financial fortress, a sovereign wealth fund, the National Welfare Fund, stuffed with cash, gold, and currencies, designed to absorb any economic shock. It was their ultimate shield against sanctions, a rainy day fund ready to fight a long, costly war. This is not a story about a gradual decline. This is about a $147 billion financial collapse that is not a theoretical model or a distant projection, but a gaping hole in Russia's balance sheet right now. This figure represents the combined cost of the Kremlin's delusion, the money they can no longer touch, the money they are being forced to spend, and the staggering deficit they are trying to paper over. When you total the catastrophic loss of its foreign currency reserves, the dizzying expenditure on a failing war, and the forced liquidation of its last genuine financial buffer, the number is clear: $147 billion. That's the financial death sentence staring straight back at the Russian economy. And it is about to accelerate the end of Putin's financial experiment. Stay tuned, because the foundation is cracking and the tremors are about to bring the whole structure down. The collapse begins with the budget. Moscow's official story, relentlessly pushed by the state media, is one of a booming, war-fueled economy. They proudly cite GDP growth figures that look healthy on paper, but they are hiding the most toxic secret in Russian finance. This growth is built on the quicksand of unprecedented deficit spending. The government is not generating wealth. It is simply printing and spending money faster than at any point since the collapse of the Soviet Union. The official 2025 budget projection set a deficit target of around 5.7 trillion rubles, roughly $63.6 billion. But that number is a fantasy. It's what they wish the deficit would be. Analysts who look at the actual spending trajectory, the 80% of the annual budget spent in the first 10 months, calculate that the real deficit for 2025 will be closer to 3.5% of GDP, a fiscal chasm that swallows everything in its path. Where does this colossal gap come from? The military-industrial complex. The war in Ukraine is not cheap. Conservative estimates put the direct cost of equipping, deploying, and sustaining operations at hundreds of billions of dollars. And it's not just the cost of missiles and tanks. It's the cost of high salaries for contract soldiers, massive state compensation for casualties, and the emergency retooling of factories that are, structurally, terribly inefficient. To keep the lights on and the war machine moving, the Kremlin has only one working financial instrument left: the National Welfare Fund, NWF. This is the last of the financial reserves, the last line of defense. And they are liquidating it at a frantic, suicidal pace. As of late 2025, the total NWF value stood at approximately $158 billion. Sounds like a lot, right? But here is the critical distinction that the Kremlin never advertises. The liquid portion, the part that can actually be converted into cash to cover the budget deficit, is only around $50 billion. That is their true, readily available war chest. When we talk about the $147 billion collapse, we are talking about what happens next. The budget deficit is a continuous fire. If the government is burning through $60 billion or more per year to cover its spending and tax shortfalls, that $50 billion liquid reserve will be gone in less than a year. They will be forced to draw down the remaining illiquid assets: gold, Chinese yuan, and investments in state projects. Assets that are far harder to convert without collapsing the domestic market or angering Beijing. This is the ultimate trap. The budget hole is so deep, and the war spending so relentless, that Russia is now consuming its own seed corn. They are not borrowing from future generations. They are incinerating the last financial remnants of the Soviet Union's natural resource legacy. And the speed of this burn rate is entirely dependent on the other half of the crisis, the oil and gas sector. For 2 years, the Western sanctions on Russian oil were considered a failure by many. Oil still flowed, and global prices were high enough to keep the Kremlin's coffers full. The price cap seemed like a leaky sieve. But we are now witnessing the delayed, catastrophic effect of sanctions, and it is manifesting as a genuine oil revenue tsunami. The $147 billion hole is getting deeper because the incoming cash flow has been throttled. Look at the numbers for November 2025. Russia's oil export revenue plunged to its lowest monthly level since the invasion, down to just $11 billion. That's a staggering $3.6 billion less than the previous year, and the oil and gas revenues for the first 9 months of the year were down 22% compared to the pre-war period. This isn't just about global oil prices. This is about the price cap working, finally. And it's working through two key mechanisms that are strangling Russia's revenue. First, the shadow fleet is breaking down. Russia relied on a shadow fleet, thousands of aging, uninsured tankers operating outside of Western jurisdiction. But the West is getting smarter. New sanctions have targeted the service providers, the insurance companies, the logistics firms, the ship-to-ship transfer points. When you make it prohibitively risky to finance and insure these ships, the cost of moving Russian oil skyrockets. That cost is then deducted directly from Russia's realized price. The discounts they are forced to offer their buyers, primarily India and China, are widening again. The actual price they are receiving after factoring in shipping, insurance, and interest is falling towards marginal production cost. Second, the targeting of refineries. Ukraine's sophisticated drone attacks on Russian refineries and export infrastructure, particularly around the Black Sea, have had a disproportionate impact. These attacks don't just reduce production. They damage critical, imported components that Russia cannot replace. When you can't refine, you have to sell crude oil at a greater discount. When you can't export efficiently, your volumes drop. The result is a double whammy of falling volumes and falling prices, a one-two punch that sends revenue spiraling. The most devastating forecast is for December 2025, where analysts project Russia's oil and gas revenues could fall by almost half compared to the previous year. Half. This is a revenue stream that funds 1/3 of the federal budget. If the money supply is halved, but the war spending continues to accelerate, funding the military, paying soldiers, subsidizing industries, that $60 billion annual deficit suddenly looks more like an $80 or $90 billion catastrophe. That is the moment the $50 billion liquid national welfare fund buffer evaporates, and the collapse transitions from a fiscal crisis to an existential economic panic. And the first place this panic shows up is in the Russian ruble. For any country, running a massive budget deficit and losing your primary source of revenue creates one inevitable consequence: a weakening currency and crippling inflation. The Russian ruble has been on a roller coaster ride, but the overall trajectory is a sickening fall. In a 2-day period in late 2025, the ruble plunged 10% against the dollar and the yuan, wiping out weeks of the central bank's desperate efforts. Why is this happening? It's the direct result of the structural economic crisis. The hard currency scarcity cycle, Russia's trade surplus, the excess of exports over imports, which provides the country with hard currency like the US dollar or Chinese yuan, is shrinking rapidly. Oil revenue is down, but demand for imports, paid for in hard currency, is up, fueled by massive government military spending. The army needs foreign microchips, machine tools, and components that Russia cannot make. This creates a self-reinforcing, toxic cycle. Government spends rubles. The state pumps trillions of rubles into the economy to pay for the war. Increased demand. This money is used to buy goods, including foreign goods, imports. Hard currency drain. Russian companies need dollars or yuan to pay for those imports, driving up demand for foreign currency. Ruble collapse. The price of the dollar and yuan soars, and the ruble plummets. To stop the ruble's freefall, the central bank is forced into financial self-harm. They had to hike their key interest rate to levels not seen since the immediate aftermath of the full-scale invasion, a dramatic, economy-crushing move. Interest rates at these levels, 15 to 21%, are like chemotherapy for the economy. They kill the cancer, inflation, but they also kill the patient, long-term investment, consumer lending, and small business activity. The irony is that even these sky-high rates are failing to fully tame inflation, which is stubbornly holding above 8.78% and pushing higher. Why? Because the inflation is not primarily monetary, it is structural and imported. Russia needs foreign goods to maintain its domestic production, and every time the ruble drops, those essential foreign components cost more, instantly fueling inflation. The $147 billion collapse is not just about the money lost. It's about the financial straitjacket it imposes. The central bank has virtually no good options left. They cannot use the frozen $300 billion in reserves in the West. They cannot rely on oil revenues. They are forced to crush the civilian economy with crippling interest rates just to prevent a full-scale currency panic, sacrificing any hope of a sustainable, non-military economic future for the sake of short-term stability. But the most damaging effects are showing up outside of the financial sphere, in the deep structural rot of the Russian industrial system. The true, long-term impact of the $147 billion collapse is the lack of capital to reinvest in the very infrastructure that keeps the country running. This is where the Soviet-era decay meets Western sanctions, creating a toxic cocktail of industrial failure. Consider Russia's lifeline, Russian railways, RZD. The vast network of tracks that transports everything from coal and oil to military equipment. RZD is running on fumes. By mid-2025, its profits had plummeted by a staggering 96%. The company is now carrying over $51 billion in debt, and the government is running out of ways to bail it out. This is not an isolated incident. It's a systemic disease. The core of the problem is the inability to maintain Western-built systems. Aviation, Russia's domestic flights are relying on cannibalized spare parts from grounded jets. Without maintenance access to Boeing and Airbus systems, safety standards are rapidly decaying, leading to a silent, escalating risk of catastrophe that will make flying within Russia a high-stakes gamble. Energy, critical components for oil and gas infrastructure, like specialized pumps and drilling heads, are imported. Their decline means aging pipelines are prone to leaks, and the efficiency of resource extraction is falling, ironically accelerating the very decline in oil revenue we just discussed. Manufacturing. The loss of precision components means that Russian factories are forced to produce lower-quality goods at higher cost, cutting productivity and any hope of competing on the global market once the war ends. Adding to this structural rot is the labor and demographic crisis. The war has created a massive labor shortage in critical industries. Hundreds of thousands of fighting-age men are mobilized or killed, and hundreds of thousands more highly skilled IT specialists, engineers, and scientists have fled the country. This isn't just an inconvenience. It's a fundamental brake on economic potential. How do you run a booming military-industrial complex when you can't get the technicians to service the machinery or the young engineers to write the software? Russia is forced to import labor from Central Asia, but that labor cannot replace the high-value, specialized expertise that has walked out the door. The collapse is therefore permanent. The short-term fix of military spending is papering over a long-term structural weakness that will leave the Russian economy globally irrelevant for decades. The $147 billion is not just a debt. It is the opportunity cost of diverting all available capital and human resources away from productive, future-proof development and into the sterile, destructive endeavor of war. It is the price of choosing tanks over trains, bullets over bridges, and short-term survival over long-term prosperity. What we are witnessing is not a recession. It is a systemic financial combustion. The $147 billion collapse is the result of three synchronized failures: the fiscal crisis, an unsupportable budget deficit burning through the last financial buffer, the liquid NWF, in less than a year; the revenue crisis, sanctions finally squeezing oil revenue by forcing wider discounts and crippling the shadow fleet, cutting the country's income stream by half; the currency crisis, high war-fueled import demand and low hard currency supply, forcing a choice between a hyperinflationary ruble collapse and a crippling interest rate environment. This triple whammy is creating a scenario where the Kremlin's desperate search for cash leads it to make increasingly radical and short-sighted decisions, liquidating more state assets, imposing new taxes, and continuing to print money, accelerating the spiral. The economic reality is no longer deniable. The financial fortress has been breached, and the war chest is empty. Russia is running on sheer momentum and the last dregs of its reserves that will be exhausted far sooner than its leadership cares to admit. This is the most critical inflection point in the Russian economy since 1998. And the next sector to fail is already clear: Russia's railways, the very backbone of its logistics and military supply chain. Will the Kremlin choose to let the tracks decay, or will they print the money for a $51 billion bailout and finally break the ruble forever? That is the topic of our next video. Hit that subscribe button so you don't miss the complete breakdown of Russia looming transportation crisis. And if you want to understand the true, hidden cost of this collapse, give this video a like and let me know in the comments. What do you think will break first, the ruble, the railways, or the National Welfare Fund? Let's discuss it below.